We're going to talk about life insurance 101. We're going to continue on life insurance 101. And today we're going to talk about universal life. And I'm going to talk about universal life in different universal life, like traditional, index, and variable universal life. But I'm going to talk about little mechanics of it. And I'll also give you some samples, quotation, to make a comparison between universal life and whole life and term insurance. All right, this is what we learned so far. Insurance type, term insurance. Term insurance is the lowest form of insurance, but there is no cash value and there is no lifetime coverage. It only have a duration. That's where the term comes, right? Term insurance, meaning there is a duration, 10 years, 15 years, 20 years, 30 years, and sometimes 40 years, but it will not give you coverage for your lifetime. However, there are some policies that is renewable. So at the end of the maturity date, the client can actually opt in for annual renewable term. Problem with that is that premium is going to be very, very high. And I mean, it's much higher than you applying brand new term insurance if you can do so. That's because insurance company know that more than likely your health is in bad situation. That's why you want to continue with that term insurance. Okay, and it is best for people who only need life insurance for limited time, like mortgage protection is one. And if you're a young family and you have a family, young children, and you want to make sure that children and your spouse is taken care of in the event of a premature death, whole term life insurance is a good product for that. Next one we talked about is a whole life. Whole life is the highest premium of all, and 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 it has a cash value. It does give you lifetime coverage, so it covers until age 99. And people, this is for people who want guaranteed lifetime death benefit. Okay. Now the next one is a universal life. Universal life is also known. I don't know whether people still call it uh, at that. When universal life first came, they called it. They did not call it universal life. They call it flexible premium whole life policy. But I'm not so sure whether they call it anymore in that term. Meaning that there's a flexibility in universal life. It's almost like whole life, but it is a little different because there's a flexibility. People, as the name kind of indicates, the client has flexibility of making payment or not making payments or making different amount of premium payments on every pay cycle as he chooses to do so. So premium could be higher or lower than whole life, depending on how the client wants to design the policy, which I'm going to talk about a little bit more. How can premium be higher than whole life? That's when you want to max fund your universal life so that you have a bigger cash value. So obviously, universal life it is a spin-off from whole life. So universal life has a cash value just like whole life, and it does provide lifetime death benefit as long as there's enough cash value. And this is best for people who want lifetime insurance, but they also want some other flexibility like cash value. Okay. Um, as we're going through with life insurance or any insurance product, we very first thing that we have to understand, well, you don't have to understand, but if you do understand this, it's going to make your life a little bit easier of understanding the product. um, why is whole life most expensive? That's because of the guarantee. The next question will be, why is guarantee more expensive? That's because, let's say we have people who are in 40s, they're purchasing a life insurance, and life expectancy is what now? About 80 some years old. So we're looking about 40 or more years down the road. And how would you determine how much the cost of the insurance will be 20, 30, 40 years from now? So you have to make certain assumption. And if you have to make a guarantee, if you have to give a guaranteed death benefit, like term insurance or whole life insurance, and in addition, um, it covers lifetime, just like whole life, and it also whole life also gives you guaranteed cash value. The minimum cash value that whole life is guaranteeing is that at the maturity date, which is at age 99, your cash value will be your initial death benefit. That's the initial guarantee of whole life policy. Now, but the thing is, you don't know exactly how much of fluctuation you're going to get in the cost. So when you are a life insurance company, obviously, since you are giving out the guarantee, you'll be very, very conservative in calculating cost of insurance. You cannot be aggressive. If you're aggressive and if you're wrong, your company is in jeopardy. So you're probably going to say, oh, okay, right now with our current interest rate, the cost for 1,000 is $2, but we need to make a guarantee for 40, 50 years. Let's call it actuarial calculation goes in and they say, okay, let's make it $3 per 1,000 or $4 per 1,000. Can you see why the cost of insurance has to go up with a guarantee? But that's only one side of the story. There's another side of the story that all actually drive the cost of insurance up. That's what we call statutory reserve. I mean, we commonly call it cash reserve. The Department of Insurance kind of dictates how insurance company will invest their money. I mean, they're not going to tell you which company, which bond they have to purchase, but they're watching over insurance company. The reason for the insurance commissioner to do that is because they want to make sure their consumers are protected. I mean, you don't want life insurance company filing bankruptcy when client passes away and their family need the money the most. So what the insurance commissioners are doing is that they're kind of dictating insurance company to set aside portion of their asset into cash equivalent account. So if insurance company give you big guarantee, that means they have to put a lot of their money into big cash reserve account, meaning cash equivalent account. If it's a cash equivalent account, does it mean that you're going to have a big rate of return on that money? No, because that money has to be readily accessible when they need it. So there is a pretty much very little or no return on that money. How is the insurance company keep up with their profit? By investing their general account, their money. But cash reserve kind of put it in a way that they're tied down some money. So more guarantee they give out to the client, more they have to set aside their asset into cash equivalent account, cash reserve. So which will also drive the cost of insurance up. That is why whenever you see the insurance company giving out the guarantee product, you'll see the increase in their premium, the cost of insurance, because the cost is higher. So two things. They need to guarantee for a long time, so which will drive the cost up. And second thing is because of the cash reserve, it has to go up. So how does insurance company deal with this situation? They come up with something called universal life. Now, universal life, what they will do is that they give you the premium will dump into the cash value, and cash value will incur interest rate. but their interest rate is not as big as whole life. So the guarantee interest rate on universal life most of the time is less than whole life. That means insurance company does not have to put up a lot of cash reserve. That means they can be more aggressive on their investing, right? They can be more aggressive because they have more money to invest. And then return on the money is more than likely it's going to be higher. So even though guaranteed interest rate on universal life will be lower than whole life, most of the time interest rate on the universal life in actuality is higher. So you get your cash value will get higher rate of return because you're getting less guarantee. So you have to think in this term, less guarantee, which kind of means higher rate of return, just like investment. Now, from the cash value, they take out cost of insurance and other expenses. So if premium is flexible, if client dictates the premium, how much premium they're going to pay, is death benefit going to be guaranteed? Not really. Does it mean death benefit can go away next day? That's not true either. Then how do they keep up with the death benefit? The death benefit is there as long as there is a little bit of money left in where? Cash value. If you have a cash value, your full death benefit will be paid. Let's say you purchase a $1 million policy and the person who purchased a $1 million policy died and he only had a $20 in cash value. Is the insurance company still going to pay $1 million? Yes. Yes. So you need to make sure, as long as you make sure that there's enough cash value to cover the cost of insurance that they take out every month, you're going to be okay. But it's not like whole life policy that there is a guarantee, regardless of the investment return of the whole life the insurance company. So less guarantee means more interest rate. That does not necessarily mean that your death benefit is jeopardized all the time. It is not. As long as you have a cash value, you are going to have death benefit. So they say IUL, but UL is the same way. Good thing about IUL or UL is a higher rate of return. The rate of return on cash value will be higher, and flexible premium so that they can skip or decrease their premium or increase their premium if they want to. And more flexibility. I mean, they can, and there's a lot of flexibility here. And because the higher rate of return, your cash value grows faster. And because of less guarantee means lower current cost of insurance. So lower expenses. And which means that you're going to have a higher cash value. That means it reduces the risk of outliving your money because there's a cash value. You can access your cash value. What about whole life? What's the good thing about whole life? It's very easy to understand. Whole life is very easy to understand. I made it a little difficult last time, but it is very easy to understand. The thing about whole life is this. You have to remember this. If you make a premium payment that insurance company calculated for you, your death benefit is guaranteed for lifetime until age 99. And what about your cash value? The cash value at age 99 is guaranteed to be your initial death benefit at age 99. That's all you have to remember as a consumer. So premium is very stable, and it's almost like a set and forget it. You set and you forget about the policy because everything is guaranteed. So people who love guarantee, they probably go with the whole life. But that's what we're seeing with especially Japanese American cultures. I see a lot of people purchasing whole life. Okay? Because they want the guarantee. It's not a bad thing. It's a matter of preference. Do you want the guarantee or do you want the growth potential? Okay. The disadvantage of IUL or UL is that must have an experienced agent, must be perfectly tailored to your family's need, which means since it has a lot of moving part on UL and IUL, the insurance agent needs to know about the product. They need to understand mechanics of the product. This is something that I've been saying over and over again, right? I told you, you have to understand the engine. I call it an engine of universal life. If you understand how universal life works, you'll be fine. And here's something that you have to understand. It's not a matter of choice. It's your obligation. It's your professional obligation to understand universal life so that you can explain it to your client and so that you can design the product that perfectly meets your client's expectation. If client wants the lowest premium for death benefit, we can do that with UL. If client wants, I want to have a big cash value when I retire, we can do that with IUL, right? And UL too. But you do have to understand, you do need to understand what the priorities of your clients are. And you have to make up right product. I'm telling you, we are pro. Here's what we need to do for a client. We need to help our client to design the product. We need to help our client explain the illustration, what we design, so that they can understand what they're actually purchasing. So you have to be able to explain your design, and you have to be able to make sure that policy that we have designed is keeping up with our original design, right? You need to make sure when there's a service, you need to understand what that service will do to that policy. So you need to understand all this, right? And how do you keep up with all this? Once again, I'm telling you to do annual policy review. Whenever there is an annual statement, meet with your client. Explain how annual statement is stacking up to original design, which also means keep your original illustration. You keep your original illustration and compare it against your annual statement. Let's say 5 years pass by. Your annual statement, your client's annual statement shows that he has a $20,000 cash value. You take that $20,000 and check against your original design. What does your original illustration shows after 5 years? Let's say after 5 years, original illustration shows $18,000. If original illustration shows $18,000 and client after 5 years has a $20,000, what does that mean? Your design is very solid. You're doing a good job, right? And so you can tell client, hey, we're outperforming our original expectation. What if you had your original illustration shows $18,000, but your annual statement shows $15,000? What do we do then? You tell the client, there's all these variables, and it is not working out for us at this point. So maybe this is the time that we need to put more premium into this, which means more than likely that it is not as good a performance as we designed. That means the market is down. When the market is down, do you need to take the money out or do you need to put the money in? That's time you need to put your money in to have a better rate of return. So you explain that to the client, and your client might say that, hey, we're doing it for long run. Maybe we should give another year and what happens. So just keep up with whatever you're doing and wait a year and see what happens. It'll eventually catch up. My 20-some years of experience, it normally matches your illustration. It pretty much, IUL, it outperforms illustration. So you tell them, hey, here's where we are. So there is a professional. The need of professional is definitely built into universal life, especially index universal life. The whole life, the disadvantage of a whole life is cash value, cash accumulation is slower because obviously the interest rate is probably lower. More guarantee means higher fees. I told you that, right, already? All right. All right, here's another one. Whole life versus universal life. Term, the duration of policy is both permanent until you die. Pricing is a level premium for whole life. It's a guaranteed premium, whereas a universal life is a flexible premium. Flexible by who? By client. All right, both gets cash value, right? And variation, the dividend, there's a possibility of getting extra dividend, and client has to decide what to do with the extra dividend. And when it comes to universal life, depending on how you grow your cash value, it can be guaranteed universal life, it could be traditional universal life, it could be variable universal life, it could be index universal life. Guaranteed universal life, more than likely you will not see much cash value, but your death benefit is guaranteed. So when it's fixed, traditional universal life, it says low. What is low? The variation, the fluctuation is very low, right? The interest rate will not jump up and down as much, which means there is a good guarantee. I mean, good stable interest rate. I should not have used the word guarantee, but it is very low on fluctuation. What is also low when there's a very little fluctuation? Rate of return. Rate of return is low. A typical universal life, they have a minimum interest rate, 2%, 3%. And you get a little bit of bump up, but you're not gonna see 8, 9%. Right? You probably see somewhere in 2%, 3%, 4% kind of deal. You're not gonna see big jump. But it's not gonna go anything below 2% if it's a minimum guarantee interest rate was 2%. If a minimum interest rate was 3%, like Columbus Life, their minimum interest rate on fixed UL is 3%. It's not going to go below 3%. So stability is there, but the growth potential is very low. The highest of all is a variable universal life. Variable universal life is insurance companies actually hiring professional fund managers, and client is actually deciding which fund managers they're going to go with. So there is treat that as think of it as a mutual fund. You're hiring mutual fund manager. That's normally who they are. So if the stock market and the fund manager is doing really, really good, you get very, very good rate of return. It could be 40%, it could be 20%, it could be 10%, 15%. I mean, you name it. And whatever the investment portfolio is performing, that's what you're getting as a client. But if performance is going negative, I mean, just like what's happening with the stock market right now, right? The stock is about 20% down from the year to date. If your money is on variable accounts, as a client, as a consumer, you're assuming that risk also. So rate of return can be high, but stability is not there. It's a very volatile. The volatility is very high. That means there is more risk, highest risk. What's index universal life? Index universal life is something in the middle. It's tied to a variable account like index account, but there is a guarantee. A lot of times the minimum guarantee is 0%. Right? Sometimes the minimum guarantee can be 1%. There are some product that's aggressive. The minimum guarantee is negative 1%. Things like that is still there. But you're not going to see anything below your minimum guarantee interest rate. Most popular one is a 0% minimum guarantee interest rate. So even if stock market goes down 40%, what is the client going to experience on his cash value? Zero. 0%. That means no losing of principal. Okay. So how cash value is grow determine what type of universal life it is. If it is a fully managed by insurance company and it goes into general account and insurance company declares interest rate every now and then for entire year, it's called fixed universal life. If it is in the index tied account and you get minimum of 0% or 1%, and there is a cap, right? Index universal life, there is a cap. So it's a moderate growth and moderate risk. There is a very little risk, right? The worst you can do is a 0%. That's index universal life. If you put it in a separate account and there's a separate fund managers, it's called variable universal life. All right. And here we go again. Death benefit option 1 and option 2. Death benefit option 1 in universal life means your initial death benefit stays level as time goes by. So let's say your client purchased $1 million life insurance and his cash value on certain point was $200,000 and he got into car accident and died, the family will get $1 million, even though there's a $200,000 cash value. That's because insurance company decrease pure insurance, also known as net amount at risk, by cash value, which kind of controls the cost of insurance, right? Because your client is only purchasing $800,000 life insurance, that means the cost of insurance is lower than doing it for 1 million, which will enhance the cash growth on cash value, right? Cash value will grow bigger with the option 1 because the cost of insurance chance of cost of insurance decreasing is very, very high. On the other hand, there is option 2. That means initial death benefit plus cash value is your current death benefit. So going back to our example, if cash value was $200,000 and the client died and initial death benefit was 1 million, they'll receive 1.2 million. But reality is that the cash value will not be $200,000. It's going to be lower. Given the same condition, probably it'll be $180,000. And the client dies at that point. It's a $1 million, 100 plus $180,000. So total death benefit that family will receive is $1,180,000. Which one is better? Who knows? If your client is planning on dying early, maybe death benefit 1, right? If client is deciding to live long time, as if he has a decision, he can decide on that. I mean, if he's planning for long term and he want to utilize his cash value, option 1. And if your client is a little tight on the budget, option 1, because option 1 will be cheaper. Okay. Here's an example. Here are the example. This is term insurance. 45-year-old male, prefer non-tobacco, and for 10-year term, $73.48 per month. 15-year term, $96.36. 20-year term, $128.92. 30-year term, $253. ART, which is annual renewable term, starts at $52.36 and it goes up every year. So the highest cost is 30 years is $253. Now let's move on to whole life. Whole life, I'm not doing I'm not playing with dividend option that we talked about last week. but I'm just gonna calculate the uh, no dividend premium. The premium for $1 million policy is $1,478.40, much higher than 30 years. That's whole life. We've seen that yet last week. Now universal life. Universal life, the premium can be as low as $783.40. $785 approximately, and you get $1 million. So this is about a little less than half of the whole life premium. But what do you get? What is the trade-off? Look at the guarantee side. As you see on the guarantee side, guarantee means lowest premium, lowest cost of the interest rate. That means 0% in this particular model, and the highest cost of insurance that is allowed by the law. Who's allowing it? Department of Insurance. Highest cost of insurance and lowest interest rate, and the policy will lapse on 21st year. Now let's see if it is realistic. If it is 20-year guarantee rate of return, meaning 0%, in order for that to happen, all the companies that index is investing on has to be either negative growth or zero growth for how many years? 20 years. And normally, if we're dealing with S&P 500 index, 500 biggest companies, corporation in United States over the next 20 years will grow, either have a zero growth, will all have a negative growth for next 20 years. What's the chance of that happening? Very, very slim. On top of that, insurance companies charging their consumer the most expensive premium, most expensive cost of insurance, expense charge, premium tax, and everything. Can insurance companies survive if you do that? Will consumer be still loyal to that insurance company? It's not gonna happen. Can I say it is guaranteed not to happen? No, I cannot. Because I cannot say it, that it is disclosed. The guarantee, the value is disclosed. That's the only downside. People get really hung up on this, and people like New York Life, Manulife, they use this and they said to the client, "Hey, look at this guarantee value. Your policy will lapse. You need to change it to whole life." And I mean, way I look at it, chance of that happening is a very, very slim. Okay. And here's another example. I told you that universal life premium can be higher than whole life. This time, we're putting $1,775.93 into this. That's the maximum it is allowed to this policy. What are we doing with this? We're putting the money, we're putting in annual premium that equates $21,311 per year for 21 years, and starting on 22 years after you retire at age 65, you're collecting $45,376 income from this policy in the form of policy loan and withdrawals. And this is, I'm not, it's because of the lack of space, I didn't show you a full illustration, but this is guaranteed to going until age 120. And that 45,000 is tax free, income tax free. And let's say this person, after withdrawing $45,000 and die, his family will receive $1.5 million, which is also tax free. The cash value, accessing tax free tax-free excess of cash value and tax-free death benefit, income tax, that is. It's not only with the universal life, but it is also true with whole life as well, right? So you can make big payment or you can make small payments. And here's the so this is actual calculation. Let's say at age 84, 40 years from the policy, total premium that is paid into this policy was $447,000. Total annual income that is drawn out of this policy, as we designed it, is $862,000. And if this person dies at that point, there's still $350,000 income tax-free death benefit. And while this is happening, there is no tax liability. Okay. And this is disclosure. Because it is not guaranteed, there's a full disclosure. The premium goes in, premium expense charge is taken out from the premium, and then it goes into cash value. From the cash value, cost of insurance come out. From the cash value, policy fee of $72 is coming out. There is a per $1,000 charges for this particular design, $4,643 for next 10 years, and it stops. That's the biggest charge. I don't like that charge. But then again, it's not that bad compared to whole life, right? And there is a charge for accumulation value charges. There's admin fees. So total charges on fifth year is a $6,839. You put $21,000 and there's charge of $6,839. Now on the fifth year, you get an interest pumping back into cash value that is $4,000. And you have accumulated cash value of $84,000. Your net death benefit of $1.08 million of death benefit. So this is fully disclosed, and sometimes it is because it is fully disclosed, people are saying it is expensive, but compared to what? Is whole life any better than this? Can you do this with the whole life? More than likely, they wouldn't. This is not, whole life is not going to be disclosed this much because it is giving you guarantee. But you're going in knowing all this, and you design the policy with this cost in mind. Your outcome, you get about $40,000 annual income, tax-free.